Hello there, this is Michael from Forex Training Group, and today we are going to discuss key concepts in fundamental analysis for Forex traders. What is fundamental analysis, first of all? Well, the basic skill involved in fundamental analysis in Forex trading requires an analyst to determine how a currency will react to macroeconomic events, central bank monetary policy shifts, and political and social news from the currency's nation of origin. Namely, you are analyzing or comparing two different economies that are being represented by the currencies that form the currency pair, and based on the differences between those two economies, the currency pair is going to move. The next thing that is of use is represented by technical analysis, and there is always a big debate regarding which one is more important, fundamental analysis or technical analysis. I would say both of them are mandatory. While the focus on the fundamental analysis generally remains on news, sentiment and the release of economic indicators, technical analysis, on the other hand, relies on the price and price movements of the underlying asset or the exchange rate of a Forex currency pair. What are the most important economic releases to be watched? First of all, the employment reports. These employment reports include the unemployment rate, number of claimants or jobless individuals applying for services, payroll levels, and so on. In the United States, for example, the most important jobs-related data is the NFP, the non-farm payrolls. Now, this non-farm payrolls, it is being released on the first Friday of every month, together with the unemployment rate. And it is important, or market moves violently because of the dual mandate the Federal Reserve, the Central Bank of the United States, is having, namely to keep inflation below or close to 2% and to create jobs. It means that traders know that the Fed is looking at the jobs data in order to move on rates, and that it is all that matters. A trade balance, basically the difference between a country's imports and exports, which has a direct effect on the demand for the nation's currencies. The bigger the trade balance is, of course, the better for the currency. Current account, on the other hand, one of two components of a nation's balance of payments. The current account is the balance of trade and net cash transfers for a country. Let's say a positive current account or an excellent is desired rather than a deficit. So the bigger the current account, the bigger the excellent, the more positive for the currency it will be. The GDP, or the total value of goods and services an economy produces, it is really important. A GDP that is growing, or a positive GDP that is growing, shows an economy that is expanding, and therefore, in order to avoid an economy that is expanding too fast, then the central bank will come and hike the interest rates. CPI, or Consumer Price Index, basically represents inflation. Now, inflation is on the mandate of each and every major central bank, and not only. So, the mandate is to keep inflation below or close to 2%. So, if inflation at any one moment of time falls to, 1.5 or 1.4, or rises to 2.6 or 2.8, then the central bank will intervene. Higher inflation means that the central bank will hike the rates. Hiking the rates, well, the currency will be more attractive. PPI represents still the inflation, but it is the inflation on the producer side, and it is being believed that in time it will be transferred to consumer as well. PMI, or the Purchasing Managers Index, represents a survey, and in this survey businesses from different sectors are being asked to answer questions relative to people that are going to be laid off, or if a specific activity in that sector, in that company, is going to influence business. How is business being viewed in the next period, and so on and so forth. And everything is interpreted to the 50 level. Namely, if the PMI for a specific sector, like the services sector, is bigger than 50, then it is being said that the sector is expanding. If the sector is expanding, then the central bank will come and hike the rates. Hiking the rates means attractive for a currency. Of course, below 50 means contraction, and PMIs are related to services or calculated to the services sector, manufacturing and construction in some countries. It depends very much the type of the economy you have in a specific country. For example, in the United States we have a service-based economy, and it means that the PMI services is more important and will affect the currency more than the PMI manufacturing, as the results in the GDP will be more visible. Commodity prices. The price of commodities can have a significant effect on the currencies of both producing and consuming nations.